Sanuwave Health, NASDAQ ticker SNWV, just missed consensus on both the top and bottom lines for the second quarter of 2026.
Yeah, a pretty tough print across the board.
Very tough. So for Q2, revenue came in at $9.74 million. That missed the $11.5 million Wall Street consensus by about 15.3%.
Right.
Which actually represents a 3% decline year over year. And on the bottom line, the company reported an adjusted loss of 8 cents per share, which missed the consensus estimate of a 3-cent loss.
And then the real kicker, they completely withdrew their full year 2026 guidance.
Just pulled it entirely. And, as for the stock reaction, it was actually relatively muted in after-hours trading, hovering right around 5.99. But, that keeps it dangerously near its 52-week low of 5.77.
Yeah, which is, that's a staggering 87% drop from its 52-week high of 46.58.
Exactly. But behind that $9.74 million revenue miss lies, frankly, one of the most bizarre paradoxes in healthcare economics.
Bizarre is definitely the right word for it.
Right. Imagine a scenario where the underlying demand for your medical product is actually hitting all-time records, yet your core business model is collapsing because you're actively competing against the ghosts of your own bankrupt customers.
It's wild. It's a really unique situation.
It is. So for you, the retail investor trying to make sense of this print, we're going to dive deep and dissect the mechanics of this quarter. We really need to unpack this massive divergence in their product segment performance, the resulting margin compression, and, of course, the regulatory headwinds that force management to pull their guidance in the first place.
Right. And to really understand all that, you have to start with how Sanuwave actually makes its money. Because when you look at the segment data, you're essentially looking at two completely different realities.
Different companies, almost.
Exactly. The business is fundamentally split into two components. You've got the capital equipment, so that's the UltraMist systems themselves. And then you have the consumables.
Which is the razor and blades model, basically.
Precisely, yeah. The consumables are the single-use applicators that are required for every individual treatment. And to understand the financial divergence here, you kind of have to understand the clinical reality of the product.
Right. It's not just some, fancy wound spray.
No. It's a device that uses low-frequency ultrasound waves to propel a saline mist directly into complex, non-healing wounds. Think like severe diabetic foot ulcers.
Okay.
The acoustic energy from the device literally stimulates cells at a microscopic level. It promotes angiogenesis, which is the formation of new blood vessels, and it significantly reduces bacterial bioburden.
So the science is solid? Clinicians clearly still believe in the therapy itself.
Oh, absolutely. But the capital equipment sales, they paint a really bleak picture right now. UltraMist system sales absolutely plummeted this quarter.
Right. They dropped, 34%?
Yeah, 34% year over year, down to $2.3 million. They only sold 82 new systems in all of Q2.
Wow.
And to put that into perspective, they sold 116 systems in the same quarter last year and 97 in just the first quarter of this year. So it's a steep sequential decline in the hardware.
But then, and here's where it gets weird, you flip over to the consumable side, the applicators, and the data tells a completely different story.
It's night and day.
Yeah. UltraMist applicator revenue was the absolute bright spot of the quarter. It increased 13% organically to $7.3 million.
Right.
And applicators accounted for roughly 75% of their total revenue this quarter, which, that is miles above management's historical target range. They usually aim for 60 to 65% for consumables.
Yeah, 75% is a massive mix shift.
It really is. And furthermore, the unit volumes for those applicators hit an all-time record, up 27% year over year.
Which is incredible growth for a mature product line.
Totally. And the number of active systems they track out in the field actually grew, too. They went from 1,382 active systems in Q1 up to 1,411 in Q2.
Right, so the footprint is expanding.
Exactly. So I have to push back a bit here, or at least play devil's advocate. If applicator volumes are up 27% and hitting records, the underlying demand for the physical wound treatment is demonstrably there.
Right.
It's growing.
Right. The patients are getting the treatments.
Right. So if treatments are more popular than ever and active systems in the field are growing, but new system sales are cratering, that tells me we're looking at a secondary market dynamic. Clinics must be acquiring these systems somewhere other than Sanuwave.
You hit the nail on the head. That's exactly what's happening. Management estimated on the call that they lost somewhere between 40 to 60 new system sales this quarter.
40 to 60, that's a lot.
Yeah, to a suddenly robust secondary market of used, highly discounted UltraMist devices. And, The math on those lost sales really illustrates the damage.
Because if you add them back in,
Right. If you add those 40 to 60 potential buyers back into the 82 units they actually sold, Sanuwave would have been right in line with their historical performance.
they might have even shown growth in the capital equipment division.
Exactly. But instead, their direct sales force was just completely undercut by the availability of cheap, lightly used machines flooding the market.
Which obviously begs the question, where are all these used machines suddenly coming from? Because if the demand for the wound care treatment itself is at record highs, independent clinics shouldn't just be liquidating their primary equipment.
No, they wouldn't.
Right, so we must be looking at some kind of external catalyst causing, widespread financial distress among these private wound care operators.
Yeah, and that financial distress stems directly from CMS, the Centers for Medicare and Medicaid Services.
Ah, of course, the regulator.
Always, right.
Mm.
Recently, CMS implemented these severe reimbursement clawbacks and pricing changes that targeted a completely different aspect of wound care. Not ultrasound, but skin substitutes.
Okay, skin substitutes. Explain that a bit for us.
So skin substitutes, which are often called allografts, are biological or synthetic tissue grafts. They're placed over a wound bed to speed up healing. In a standard clinical workflow, a practitioner might use an ultramist system first, right, to clean and prep the wound bed. And then they apply this high-margin skin substitute right over the top.
Okay, so they go hand in hand in the clinic.
Exactly. Now, the CEO noted on the earnings call that CMS basically looked at this $14 billion skin substitute space and gave it a 95% haircut.
95%.
Yeah.
That's not a haircut, that's a decapitation.
It really is. They dropped the reimbursement rate to a flat $127 per square centimeter.
Wow. Okay, so think of those CMS skin substitute reimbursements like the anchor tenant in a local shopping mall.
Oh, that's a great way to look at it.
Right. It was the massive cash flow engine that brought in the revenue and essentially kept the lights on for the entire clinic operation. So when CMS slashed that rate by 95% overnight, it's the equivalent of the anchor tenant just abruptly breaking their lease and moving out.
The mall loses its main draw.
Exactly. The clinic still had these highly effective secondary tools like ultramist for patient care, but without that core allograft revenue subsidizing their high overhead costs.
The math just stops working.
Yeah, the entire operation becomes insolvent. The mall goes bankrupt.
And the downstream effect on Sanuwave's business model is undeniable. These independent clinics that built their operating models around those generous skin substitute reimbursements, they suddenly found themselves facing massive clawbacks for past payments, plus a total evaporation of future cash flow.
So they just hold.
Hundreds of clinics simply couldn't survive the shock, and when those clinics declare bankruptcy, their assets get liquidated to pay off creditors.
Which includes perfectly good ultramist system.
Exactly. Perfectly functional ultramist systems get dumped onto the secondary market at pennies on the dollar.
Yeah.
So it isn't that Sanuwave lost market share to some, competing ultrasound device.
Right.
Their sales team is literally losing deals to the liquidated assets of their own former customers.
That is just brutal. But, that flood of cheap secondary market machines didn't just hurt top-line system sales. It actively cannibalized their profitability.
Oh, it wrecked the margins.
When you look at the gross margins, this shift toward a lower dollar consumable mix absolutely crushed their bottom line this quarter. Gross margin compressed by nearly 200 basis points. It fell from 78.1% a year ago down to 76.2%.
Right. And while single-use applicators generally carry healthy percentage margins, the raw gross profit dollars that come from selling a high-ticket capital device are just missing.
The actual cash coming in the door is much lower.
Exactly. Plus, management noted a lower average selling price on the 82 new systems they did actually manage to sell.
Because they lost pricing power.
Totally. In a tough environment where buyers know they can just go to the secondary market, Sanuwave had to rely a lot more heavily on third-party resellers to move product.
Right, which means sharing the pie.
Yeah, it meant sacrificing pricing power and margin just to get the units out the door.
And the financial fallout showed up immediately as you move down the income statement. Their operating results swung from a $1.4 million profit in Q2 of last year to a $0.3 million loss this quarter.
Ouch.
Yeah. And the net results similarly swung from a $0.6 million profit to a $0.7 million loss. Even when we look at adjusted EBITDA, which, strips out a lot of the non-cash accounting noise, it fell drastically from $3.2 million down to just $1.2 million.
That's a huge drop.
It really is.
Yeah.
And it raises a fundamental challenge regarding the long-term viability of their current operating model. Because if the recurring revenue side of the business, the applicators,
Mm.
is firing on all cylinders and setting records, but adjusted EBITDA is still shrinking by nearly two-thirds,
Right.
doesn't that suggest the recurring revenue alone simply isn't enough to sustain the business at its current scale?
It definitely suggests that. It highlights a classic issue of operating leverage. I mean, Sanuwave's cost structure funding, a national sales force, maintaining R&D, covering all that administrative overhead, it was built on the assumption that they would sell a steady volume of capital equipment.
Right. You need the big ticket items to cover the big fixed costs.
Exactly. Consumables provide incredibly predictable, sticky cash flow, which is great for stability, but they don't provide those massive lump sum margin dollars required to cover heavy fixed costs.
So there's bleeding cash on the overhead.
Yeah, the lost margin dollars from those 40 to 60 missed system sales created a structural deficit in the quarter. The incremental profit from selling 27% more applicators simply couldn't fill the gaping hole left by the missing hardware sales.
Which brings us to the guidance. This structural deficit, combined with the ongoing chaos in the clinic market, perfectly explains why management essentially threw in the towel on predicting the near-term future.
They had no choice, really.
Right. Looking ahead, Sanuwave officially withdrew its full-year 2026 guidance. They stated they will not issue new financial guidance until the final CMS rule is published, which they anticipate happening sometime in the fourth quarter.
And, pulling guidance obviously introduces massive uncertainty for institutional investors. But management is basically waiting for clarity on yet another looming regulatory threat.
There's more.
Oh yeah, CMS has issued a proposed rule for 2027 regarding CPT code 97610.
Okay, and just for context, for you listening, a CPT code is the universal billing code a physician uses to get paid by Medicare for performing a specific medical procedure.
Right. And code 97610 specifically governs the reimbursement for the time a clinician spends actually applying the ultra-mist ultrasound therapy in a private physician's office setting.
Okay, so that's directly hitting Sanuwave's core therapy.
Directly. And if it's implemented as currently written, CMS could drop the reimbursement rate for that specific code from an average of $397 down to roughly $316.
Wow, that's a 20.4% cut to the core therapy reimbursement rate.
Exactly.
I mean, that would put immediate compounding financial pressure on whatever independent private wound care clinics actually manage to survive the whole skin substitute bloodbath we talked about earlier.
Right. The private physician office market is effectively a burning building right now.
Yeah, get out while you can.
But, there is a distinct silver lining hidden in the regulatory filings.
Okay, I love a silver lining.
While the physician office setting is facing these massive cuts, the hospital outpatient proposed rule actually calls for a 14% reimbursement increase in 2027 for the exact same therapy.
Wait, really? A 14% increase just for doing it in a hospital instead of a private clinic?
Yep, the exact same procedure. And in response to these diverging regulatory paths, Sanuwave is actively executing a massive strategic pivot. They're directing their sales force away from those vulnerable private physician offices and targeting hospital outpatient clinics, specialized burn care centers, and pediatric hospitals.
Where the economics are actually improving.
Exactly. They're following the money.
That makes sense. But a strategic pivot of that magnitude introduces severe execution risk. Primarily because of the timeline, right?
Oh, absolutely. The sales cycles are completely different.
Right, because selling to a private clinic often involves pitching directly to the physician who owns the practice. You walk in, you shake hands, you make a deal.
Exactly. But selling to a hospital system, that requires navigating labyrinthine procurement committees, integrating with hospital IT systems, establishing completely new clinical workflows across multiple departments. It is a painfully slow, bureaucratic sales cycle.
And time might be a luxury Sanuwave simply doesn't have right now, especially when we scrutinize the balance sheet and the internal risks they disclosed in this quarter's 10Q filing.
Yeah, the 10Q had some pretty concerning notes.
To put it lightly,
Yeah.
they reported having $9.4 million in cash on hand, which sounds okay until you see that they simultaneously face a $4.5 million accrued liability for state and local sales taxes, interest, and penalties related to past voluntary disclosure agreements.
Right, so a $4.5 million tax liability immediately cuts their functional cash runway in half.
Overnight.
And beyond the cash constraints, the 10Q disclosed material weaknesses in their internal control over financial reporting.
Oh boy.
Yeah, management specifically cited an insufficient number of accounting staff, fundamental issues with revenue recognition controls, and broad IT control gaps.
I mean, an insufficient accounting staff for a publicly traded company on the NASDAQ is an immediate red flag for any institutional investor.
It's basically a siren going off.
Yeah. If there are material weaknesses in revenue recognition controls, it casts a shadow of doubt over the entire financial print. Investors have to wonder if that amazing 75% consumable mix was perfectly accounted for, or if the growth algorithm is slightly skewed by bad accounting.
You just don't know for sure.
Right. And when you combine a complex strategic pivot to a completely new hospital customer base with a fragile balance sheet and admitted weaknesses in internal financial reporting, the path forward looks incredibly narrow. It clearly explains why the stock is sitting 87% below its 52-week high.
The market hates uncertainty, and right now, SNWV is full of it. The chain of causality here is brutal, but it's essential for investors to understand.
Walk us through the dominoes one more time.
Okay, so first, CMS regulatory rules regarding skin substitutes effectively bankrupt hundreds of independent wound care clinics.
Right.
Then, those bankrupt clinics liquidate their assets, which causes used Ultramist systems to flood the secondary market at steep discounts.
Domino 2.
Yep. Then, that sudden flood causes Sanuwave's new system sales to plummet by 34%. The resulting shift in revenue mix heavily toward lower-dollar consumables compresses their gross margins, swinging the entire company to a net loss.
And then the final blow.
Right. With more potential CMS reimbursement cuts looming for physician offices in 2027, management is forced to pull their financial guidance entirely while they attempt to pivot the business toward hospital systems.
It's just a devastating sequence of events. Yet despite all of that, we have to return to the core clinical reality here. The underlying demand for the actual medical treatment hasn't vanished.
Not at all.
In fact, it's growing. The active Ultramist systems in the field actually grew this quarter to 1,411 devices, and applicator volumes hit absolute record highs.
The patients still need the therapy, and the therapy works.
Exactly. Which leaves you with a deeply provocative thought to ponder regarding the future of Sanuwave. Because right now, there are more functional Ultramist machines out in the wild treating patients than ever before, even if Sanuwave didn't sell those specific machines directly this quarter.
Right, the installed base is theoretically larger than their direct sales imply.
Right. So if a company can somehow survive the brutal cash crunch of the next few quarters, I mean, if they can weather the $4.5 million tax liability, resolve their internal accounting weaknesses, and let this current flood of secondary market systems naturally dry up while their hospital sales pivot takes root.
That is a lot of ifs.
And it's a huge if, but if they can, could this bizarre market dynamic actually serve as a Trojan horse? Could this current flood of liquidated used systems paradoxically seed a massive high-margin consumables base that generates recurring revenue for years to come?
It's certainly possible. I mean, every machine out there needs a steady supply of applicators.
Exactly. Or, on the flip side, will the sheer crushing weight of their internal liabilities and aggressive CMS regulations just break the company before they ever get to see that future?
It's going to be a very tense couple of quarters for anyone holding the stock, that's for sure.
Absolutely. Well, if you found this breakdown valuable, make sure to follow the show. We are here every day unpacking the vital mechanics behind the earnings reports you need to know about.